Mahesh, thanks very much for taking out the time and joining in. Obviously, you would have had your own analysis on what this does for companies and how this affects their EPS growth, and then whether or not it's time to see a re-rating on some of the companies and some of the sectors on the basis of that. What would your end of year target look like for the index now on the basis of all that's happened over the last 2 weeks?
Well, good morning, everyone. What has happened over the last 2 weeks, especially referring to the corporate tax rate cut, is obviously a big positive. And while the theoretical EPS upgrade coming on the back of the corporate tax rate cut could be in the region of, say, 8 to 9% for, let's say, the Nifty as a whole, but the real EPS upgrade is actually going to be far lower than what the theoretical upgrade is, because of a couple of reasons. One is how exactly do the companies treat this corporate tax cut, and what kind of benefit get passed on through to the EPS level. And the second question obviously is there have been some pending earning revisions on the downside because of the much sharper slowdown that we have seen in the September quarter as compared to the June quarter. And the analysts have obviously sort of used that downgrade, which was potential and which was still waiting to happen, into the numbers. So the real upgrade is probably around 4% or so. And so to that extent, market did go up much higher, and now we have come back to a level which is about 4 to 5% higher than where we were before the corporate tax announcement. So I would say that the EPS revisions have broadly been factored in, but I would say that this is a re-rating event as well, which the market has not really given a due credit to just as yet. So therefore we remain optimistic, and our 12-month target on Nifty is about 12,500, so roughly say about 10% plus type of returns over the next 12 months.
All right. So while obviously this leaves some room on the upside for Indian equities, you need that large chunk of money to come in to drive interest back to those levels on the index. And so far, even if you have to analyze the last week's performance or last 2 weeks' performance post corporate tax earnings, again, it's a question of those big heavy hands that have been at play that have driven the index to levels of about 11,600 that it originally hit. So it's not like the rest of the market is contributing. It's not like the broader markets have turned around in a jiffy, or even for that matter, the bottom 30 weighted stocks on the index have done anything. It's just the top 10 stocks on the index which have done what they've done.
Yes, so there continues to be that polarization, of the market. We haven't really seen, the changes at the broader market level, and I guess that will take some time, because the changes on the ground, the real economic changes will take some time. I mean, simply because the corporate tax rate has been cut, I don't think the companies really make changes into their plans straight away. So it's going to take a while, and as we have seen, the economic data over the last couple of months has definitely worsened. I mean, I would definitely say that September quarter YOY numbers are looking far weaker as compared to the June quarter. So I think that also needs to be taken into account. So my sense is that it's going to take a while, but we feel that probably the September quarter will be the quarter where we will see things bottoming out, even from the economic activity perspective as well, the GDP growth perspective. And from the December quarter onwards, we will obviously have the benefit, a little bit of benefit of the YOY comparisons becoming easier, and also the impact of lower rate cuts and better liquidity, etc., beginning to flow through in the system.
Mahesh, good morning. Neeraj here. Do you get a sense that your key clients might be inclined to, or might show acceptance to, starting to bet beyond the 25-30 performers, not just the Nifty but beyond as well? Even in banks, for example, we're still seeing the HDFCs and the Kotak banks doing very well, while ICICI and Axis had some days of uptakes. They've cooled off too, and the other ones keep on languishing. So even in the 35% of the weightage of the market, the preferences still haven't changed.
Well, see, the Indian market has generally, become like a hope market, right, over the last couple of years. And there has always been this expectation of, broader market rebound or the earnings growth rebounding, which hasn't really translated into reality so far. So a lot of investors, want to kind of, see the reality, before jumping in. So my sense is that yes, there is some inclination, and clearly the valuation gap has widened. Between the leaders and the stocks that haven't really participated as much into the rally, also the mid caps versus large caps, and my sense is that trade is going to happen, I would say, over the next 6 to 12 months and probably beyond, but it's not going to start in a hurry because, as I said, now India has become the show me the money market, where people do want to see the hope actually showing, at least to some extent, into the reality.
What about the later stage financials? And sorry, let me rephrase my question. We've talked about banks enough. The ones which have performed really well are some of the non-lending financials. It's a small pack, but insurance has done fabulously well in the last 6 to 9 odd months. We're seeing asset management companies, even though there is only one notable name out there, doing extremely well. What's the house view out there, Mahesh, and what do you personally believe? Can there be more gains in this space, which seems extremely overvalued optically?
So, we as a house, continue to be overweight on the banks and financials. We still have, clearly an overweight stance on the private financials and banks within that, with kind of a well spread out, portfolio for the private banks, the retail banks, versus the corporate banks as well. Talking about the non-lending financials, which is the life insurance, general insurance, asset management, and so on. There is clearly, a view that this is, one sector which doesn't really have any headwinds, like some of the banking or the lending sector still has in the minds of investor, whether, it is to do with NPL or whether it's to do with, the worries on the margins, the NIMs, because, as the leading state-owned banks, start offering, a repo rate linked product, it could pressurize the margins. So these are still the two concerns on the banking side, even on the private banking side. But on the non-lending side, clearly we don't really have any concerns. Yes, the valuations have gone up, but the business fundamentals are strong, and it doesn't really have too much of concern. So this is clearly emerging as one of the sectors where the valuations can look optically, on the expensive side. But I think, if we take a leaf out of what we have seen in the Indian markets over the last several years, there are a few sectors like consumer staples, consumer discretionary, where the valuations did appear quite expensive for a long period of time, and it still does. And my sense is that the non-lending financial as a sector is getting into that phase. So I will not really be too much worried because of the high multiples on that space just as yet, because it's just the beginning. And my sense is that the stocks can continue to deliver returns in line with the earnings growth, which are going to be, in my view, in high double digits.
Okay, so just to get this correct, Mahesh, you're saying that here on the re-rating may not happen on the valuation front for maybe the insurance companies, but earnings-led valuations may stay higher, and earnings-led momentum could give the stock returns. Am I correct?
Absolutely. So I'm not really worried about the valuations being on a higher side. I think it can continue to remain at those elevated levels for a very long period of time.
Mahesh, almost a year ago or so, CLSA as a house was pretty positive on real estate and some of the bigger developers. Does that stance stay, or with whatever's been happening with regards to pressure building up on funding lines for developers defaulting on loans to NBFCs, that stance changes a bit, or you modify it a bit?
Not at all. That stand, very much remains, on track. And over the last 12 months, as you rightly remembered, some of these property developers have actually kind of delivered sort of pretty decent returns and above market, despite the broader mid-cap or the small-cap segment has done quite badly as such. So in the context of that, the property developers, most of which names are in the mid-cap segment, have actually outperformed in a pretty decent way. My sense is that the events that you talked about, where there is some rising risk of some developers defaulting, or the possibility of some of them probably facing some kind of credit issues, etc., is all actually a relative good news for the names in the listed space, because most of these companies continue to actually benefit on a relative basis out of the stress that we are seeing in some of these smaller unorganized developers, etc., and the market share shift continues to happen. So even if one does not take a very bullish view on the real estate market as a whole, but definitely the listed developers, which is a very small part of that broader real estate market, can easily continue to gain share and deliver much better returns. So yes, to answer your question, we still continue to remain very bullish on the real estate developer space.
How much prominence are you giving to the wane on what's happening globally to domestic sectors like metals, which have really suffered at the hands of weaker cues coming about globally, the China-US trade war? We've not really seen that upcycle for them in a really long time.
That's true. So global cues are very, very important, because the markets don't necessarily just respond to the local developments. A lot depends on what's happening globally, and a lot depends on what's happening to the FII sentiments and the FII flows. And we clearly been having this view as our house view for last 12 months or even more, that the global growth is slowing down, and the concerns are coming up on the growth expectations now in the US, Europe, China as well, and that obviously doesn't really bode well for the global commodities and the metal sector. So that continues to remain a big underweight in our portfolio. In fact, we're not recommending any metal stock at this point in time. So yes, so we are not jumping into doing a bottom fishing on that space.
Just one more question that I had with regards to going back to financials, and what's your take on whatever has been announced in the recent past with regards to whether or not it means pushing back of NPAs that are in the MSME segments, to external benchmarking of loan rates, to the consolidation of PSU banks, so many developments in what we've been seeing in the financial space, and how does that play out for you?
Well, the way it plays out, to my mind, is that the financial sector clearly plays a very, very important role in the broader economic activities in the country, right? And so what makes us optimistic, on that space is that, one, we are clearly seeing the inflation remaining low, and therefore we continue to believe that there is a lot of room for the RBI to still cut rates. We expect another 75 basis points, somewhere around that kind of a cumulative rate cut that RBI can possibly do in the current cycle. And we are just about begin seeing the transmission of the lower policy rates into the bank lending rates as well. And my sense is that that process will also be accelerated because of, one, we are now seeing reasonable level of liquidity in the banking system, which is very visible in the fact that the banks as a whole are depositing almost 1.3 to 1.5 trillion rupees with the RBI under reverse repo. So that means clearly there is enough liquidity in the banking system. And the government has also started putting money into the equity capital of the state-owned banks. They've committed almost $10 billion. And my sense is, as a combination of equity infusion as well as ample liquidity, means that the transmission should happen, and the risk appetite in the banking and finance space should slowly begin to get normalized. So currently we are clearly at a situation where there is huge amount of risk averseness, and that's the reason the money multiplier has also come down. But with these two things, reasonable liquidity and equity infusion, we feel that the money market, the money sort of multiplier will slowly begin to get normalized. The risk appetite begins to get normalized, and that's the reason why we feel that the economy might be bottoming out sooner rather than later.
Okay, Mahesh, time for one last question. I was thinking of asking you either IT or auto. I'm choosing autos because that's the more in thing right now. The stocks are no longer at the levels that they were at before September 20th. Is there still merit in trying to own these names? Do you believe that there could be returns?
Well, we are still cautious. We are still underweight on autos as a space. But where I would probably like to start accumulating is the four-wheeler segment. I would still say that a two-wheeler is still not a very structural long-term story. Yes, you can see some small term bounce, and maybe the growth can bounce back up from a shorter term perspective. But it is still a sector that I'm not going to bet on with a longer term view. But yes, maybe the four-wheeler, the passenger car vehicle segment is where I will probably like to start. But it's not a kind of a decision that I'm going to take in a hurry. So, I mean, I can rather wait. But if I have to, then maybe the passenger car segment is where I will start buying.
I think your advice is well taken. Maybe people should rather wait, and nobody just has to. But Mahesh, it was so good chatting with you today on an important juncture for the markets. Thanks so much for taking the time out and being with us today.